Hey there, and welcome. Today, we are tackling something that I think is going to be a game changer for a lot of you. We're cutting through all that Wall Street noise to talk about a strategy that's, well, it's so simple, it's brilliant. It's the three-fund portfolio. Let's get right into it. Okay, so let's be real for a second. Have you ever logged into your brokerage account, looked at all the options, and just felt your brain melt? You are not alone. I mean, look at this number. There are almost 15,000 ETFs traded in the world. 15,000. It's just a sea of complexity. But here's a thought. What if winning at investing isn't about finding that one perfect magical fund? What if it's about making way fewer choices? And that idea leads us straight to a legend in the investing world, John Jack Bogle. He's the guy who founded Vanguard, and his whole philosophy was frankly revolutionary for its time. He basically said, hey, stop driving yourself crazy trying to find the one winning needle in this massive stock market haystack. Just buy the whole haystack. And this quote, it just sums up that entire mindset perfectly. So here's what we're going to cover. First, we'll touch a bit more on why investing can feel so overwhelming. Then we'll get into the three-fund solution itself. After that, we'll talk about how to actually pick your funds and what is by far your most important decision. And finally, we'll cover how to keep this thing running with, and I'm not kidding, almost no effort. All right, so let's get to the good stuff. What is this simple, elegant solution? Well, it actually has a nickname. People call it the lazy portfolio. And honestly, I love that because it's designed to be super effective and diversified, but also incredibly hands-off. It's built to free you up to, live your life instead of staring at stock charts all day. So what is it really? When you boil it all down, the three-fund portfolio is just a super simple, diversified investing strategy. You're using just three low-cost index funds to capture the returns of the entire market. See, the goal here isn't to be a genius and beat the market. The goal is to be the market. You're basically owning a tiny little slice of almost everything out there. And here they are, the three magic ingredients. First up, you've got a total U.S. stock market fund. This is your ticket to the growth of the entire American economy. Second, you need a total international stock market fund. This gives you that global reach, spreading your investments across the rest of the world. And third, you have a total U.S. bond market fund. Think of this one as your portfolio's shock absorber. It's there to provide stability when the stock market inevitably gets a little crazy. So why is this so powerful? Well, these three things work together in this perfect little loop. First, it's simple. So simple that it's actually easy to understand and, more importantly, stick with. Second, the diversification is just massive. With just three funds, you own literally thousands of stocks and bonds from all over the globe. And third, and this is a big one, it's low cost. You're using index funds that have incredibly low fees, which means more of your money stays in your pocket working for you. Okay, theory is great, but let's get practical. How do you actually go out and build one of these? Think of it like a recipe. We've got the concept down, now we just need to pick our ingredients. And we want them to be high quality and low cost. And here are some really popular options from two of the biggest names out there, Vanguard and Fidelity. You can see they each offer funds for U.S. stocks, international stocks, and U.S. bonds. But I want you to look at that last column, the expense ratio. Just look at how tiny those numbers are. I mean, we're talking hundredths of a percent. And yeah, you're reading that correctly. Fidelity has options with a 0% expense ratio. It's incredible. So what does a number like 0.03% actually mean? Let's put it in real-world terms. If you have $10,000 invested, your annual fee for that fund is just $3 for the whole year. $3. That is the power of low-cost investing. And over decades, that small difference adds up to a massive amount of money staying with you. Okay, so you've got your three ingredients. Now comes what is, without a doubt, the single most important decision you are going to make. And listen closely, it's not which Vanguard fund versus which Fidelity fund you pick. It's the mix. It's the ratio of stocks to bonds. This is called your asset allocation, and it's what's going to determine almost everything about your portfolio's journey. And that mix, it has to be tailored specifically to you. It really boils down to two key questions. First, what's your time horizon? As in, how many years until you plan on needing this money? And second, what's your risk tolerance? And by that I mean, how much can you stomach the market's ups and downs without freaking out and selling everything? Be honest with yourself on that one. So let's look at an example. Here's what we'd call an aggressive allocation. 90% stocks, just 10% bonds. Now, who is this for? Typically, this is for someone who's young, maybe in their 20s or 30s. They've got decades and decades before retirement, so they can afford to take on more risk for a shot at higher returns because they have plenty of time to ride out any bumps in the road. Okay, how about something a bit more moderate? Maybe 70% stocks and 30% bonds. This could be a really good fit for someone who's a little further along, say in their 40s or 50s. You still want that solid growth from stocks, but now you have a much bigger cushion with that 30% in bonds. It just helps smooth out the ride. And finally, let's look at a conservative allocation. This is the classic 60-40 portfolio, 60% stocks, 40% bonds. This is often perfect for people who are getting close to retirement or are already in it. See, the goal isn't just pure growth anymore. It's shifted to protecting what you have while still getting some modest growth. So let's put it all together. How does this actually look? Let's say you decide on an 80-20 split, 80% stocks, 20% bonds. Great. Now you just have to split that stock portion. A pretty common way to do it is to put 80% of your stocks in the US and 20% international. So you do the math and bam. Your total portfolio is 64% US stocks, 16% international stocks, and your original 20% in bonds. That's it. It's that simple. All right, last piece of the puzzle. How do you maintain this thing? This is where that lazy portfolio nickname really earns its keep. The whole point is to not mess with it all the time. It's a set it and review approach. Rebalancing sounds complicated, but it's not. All you do is check in on your portfolio once a year. Your birthday is a great day to do it. You just log in and see where you're at. So let's say stocks had an amazing year, and now your 80-20 portfolio is sitting at 85-15. Well, to rebalance, you just sell a little bit of your stocks, the part that grew, and use that money to buy more bonds to get back to your 80-20 target. Now, think about what you just did there. You automatically sold high and bought low, without any emotion or guesswork. It's kind of genius, right? And really, this is what it's all about. It's about freedom. Freedom from watching the financial news every day. Freedom from stressing about the hot stock tip your buddy told you about. You've built this simple, strong, diversified portfolio that's designed to work for decades. Now, you can just let it work. So does all this simplicity actually work? What's the payoff? Well, one analysis looked at a sample 3-fund portfolio over a 10-year stretch and found it returned an average of 8.7% per year. Now, of course, you know the drill. Past performance doesn't guarantee future results, but it's a pretty powerful example of just how effective this super simple, low-cost approach can be over the long haul. And that really brings us to the final and maybe the most important question of all. See, a strategy like this isn't just about the numbers in your account. It's about what you get back. It's about reclaiming your time, your mental energy, your peace of mind. When you simplify your investing, you free up your most valuable asset, your attention, to spend on the things in life that actually matter. So the question is, what are you going to do with all that time?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.